Let's talk markets and the outlook going forward. Dharmesh Kant, Head of Research Retail at Motilal Oswal, joins us on the show. Afternoon, Dharmesh. Of course, it's a quiet week, but a couple of big earnings that we're watching out from the tech space, as also IndusInd earnings coming up. Just going into the Q2 earnings season, what's your perspective? Are we at a cycle where earnings recovery could look a little more real going forward from here?
Yeah, good afternoon. Definitely, we are looking at further positive earnings traction going into Q2, FY17, primarily driven by the consumption space. So, if you look at the automobile numbers, they were really good, and I think that should trickle down to other consumption space, be it white goods or electrical consumer space. Apart from that, we expect metals to post a healthy earnings growth. IT should be a muted, though fireworks is expected there, but we would be closely monitoring the management commentary of Infosys because they have stated earlier that the fallout of Brexit will be assessed after the announcement of Q2 FY17 earnings. So that is one thing to look out for. TCS is also coming with the numbers, and IndusInd Bank kicks off the private sector. I mean, the South Indian Bank has already come out with the numbers. They were pretty in line. IndusInd Bank would be looked forward to more closely as it's a larger say on the economy. More or less, banking space, we expect positive surprises more than negative surprises, and slippages to decelerate further in the public sector banking space. So net speaking, on the entire earnings trajectory, we think this quarter should be much better than what we saw in Q1 and Q4 of FY16.
Dharmesh, how are you viewing the cement space, and are there any specific companies that you're looking at carefully at this stage?
See, cement has been buzzing quite off late, and the volume traction has already been seen in the entire space, and we think that it's likely to continue going forward because post monsoons and the 7th Pay Commission rollout, the demand for housing in rural and semi-urban areas will accelerate further. So till now it was more of a infra-driven consumption into the cement space. Now even housing will take a front seat. So both these will keep the volume uptick going. Cement companies have taken price hikes in the recent past, even in the South India. So we think that trend is likely to continue. So overall, 12 to 13% kind of a blended realization growth what we are expecting on the realization front, and with volume also trickling in. So there will be companies in the mid and small cap segment which would be reporting around 17 to 20% kind of a revenue growth. So very bullish on the cement space. On the top large cap stock, Ultratech is our top pick, where we are recommending buying with 2 to 3 years kind of a perspective. And it's a stock which is due for re-rating, is the highest capacity, and capacity utilization again is a key factor because the more you utilize capacity, the higher the operating leverage play comes into the space. On the mid and small cap segment, Ramco Cement, JK Cement and JK Lakshmi Cement and Dalmia Bharat. These are the 4 stocks on which we are bullish on, and we are recommending our clients to accumulate them at all levels.
Right. Dharmesh, of course, we keep talking about banks, and they have been a major contributor to the recent market rally, flirting with those 20,000 levels on the bank nifty. But it's been difficult to get a real picture as far as how accurate these bank earnings are for the last few quarters, because you had the mandated AQR in the previous quarters. This quarter, of course, you're likely to see a one-time bump up from those treasury gains. Just an outlook on the banking space and banking earnings going forward. How are those shaping up? Regardless of some of these one-off events that we've seen, whether it's AQR or treasury gains?
See, as far as core earnings are concerned and the core operational efficiency is concerned, on both those counts, banks have been doing pretty well, primarily driven by the retail consumption space, because as far as industrial space is concerned, capex has not taken up till now. So, and that's likely to remain muted for the balance of FY17 as well. So, because right now, large corporates are fighting with capacity utilization. So, capex will take a front seat only in FY18 and FY19, or not in FY17. So, industrial space will remain muted. Capital goods space will remain muted, but retail space is what entire BFSI has been very bullish on, and that's the space which has been gaining traction. And that is what we have seen with be it private sector bank or public sector bank. The loan book growth is coming from that space. AQR, yeah, we were expecting even Q1 FY17 that AQR slippages would be high and there would be deceleration there, but it came a tad higher for some of the PSB basket and ICICI Bank from the private sector space. This quarter, again, that has to be seen. Though we expect the slippages will decelerate, but final numbers has to be seen before we conclude on that. But operational front, retail segment has been booming, and that is what is going to drive the growth for the private sector space. We expect around higher 20, near 20% kind of growth on the AUM. On the public sector space, again 17 to 18% for banks like SBI and Bank of Baroda is expected, and others will be around 10 to 12% kind of a loan book growth. So overall, things are looking positive on the loan book growth side. Slippages should be down this time around, and that should boost the profitability on the bottom line.
Dharmesh, I'm just going to ask you to hold on because we're seeing that Tata Motors is continuing to zoom ahead as the festive season has gotten underway and passenger vehicle sales have been surging. We managed to speak to Mayank Parikh of Tata Motors on what's really driving that optimism and their outlook ahead. Hear that conversation.
I think we are quite bullish. The first festival actually starts from south, the Onam, and that's where the festivities begin. And I think that month was very good in Kerala. We grew almost more than 50% in Kerala in that month. Navratras are going on already. The initial counter reports say that we are looking at again yet another good month. If you see if I divide this year into two quarters, first quarter and second quarter, first quarter the growth was very modest. Industry grew by around 7%. It was second quarter, July, August, September, when the industry grew by almost 17.5%. And that has actually given us good hope for the festival season. Of course, we have outgrown the industry. In the quarter two, we have grown by 24%. And we think and we are quite confident that the same momentum will continue. Yeah, as you know, we launched in April Tata Tiago, and the response has been extremely good. We got more than 50,000 bookings and growing by the day. Also, we are making an entry into a UV space with our flagship car called Hexa. That will be coming in the month of January 2017. See, broadly, if I had to describe the market, we are present only in around 60% of the market. Going forward, our endeavor will be to increase our addressable market to 100%. And also strengthen our product offering in the existing coverage. So definitely going forward, new product launches will be a big thirst from Tata Motors.
There is just, specifically on Tata Motors, of course, what your call is, but how are you looking at the auto sector? And within that, of course, there's a lot of optimism that certain companies have ahead of this festive season. But give me a sense as to what you're betting on in that particular space. Dharmesh, I'm wondering if you can hear me. I don't know if you managed to hear that full conversation that we were just airing for our viewers from Tata Motors. But how are you looking at the company, and are there any bets that you have within the auto space?
See, auto space is quite excited and looking fairly good. The numbers of September were quite encouraging, be it Maruti, Hero MotoCorp, TVS Motor, Eicher Motors, all came out with, robust set of numbers, Scots for that matter. But coming to Tata Motors, I think there are too many divergent triggers out there, and different geographies, keep on coming out with different set of numbers. They have their own set of problems, be it Euro region or a China or a US market. So mainly Tata Motors is now of a JLR Land Rover story, and that's being balancing out between the different parts of the geography between US, Europe and China. Back home, they have been very aggressive in launching new models on the PV side, but none of the models have been able to make the foray which Tata Motors were looking at. So that has to be taken with a pinch of salt. But just on the valuation perspective, I think it's a very cheap stock, available at 8-9 times FY18 earnings multiple. So a value buy, one can be invested in that. But the top picks from the auto space on the four-wheeler side remains Maruti. the company has been doing phenomenally well. They have been coming out with new launches, and they are very competitive to their other models like be it of Hyundai or Toyota. And both of them are not in the listed space. So on the passenger vehicle side, any company with very good product offering and good sales traction, Maruti is the only choice one has to buy. And on the two-wheeler space, I think Hero MotoCorp remains the preferred pick from our side. The company posted one of the best numbers in the month of September. 50 new launches have been, planned. 3 are in this festive season itself. And the scooter segment has been also doing fairly well. So on the back of good monsoons, GST, and the 7th pay commission, and after the festive season, the marriage season starts. So all these things should be, working out well for Hero MotoCorp. So that is another stock which we are pitching our investors to keep on acclimating.
Dharmesh, what could be the next dark horse in the markets, as it were? You've already seen a sharp run-up come in, of course, on the consumer names because of the festive season. Cement has seen a strong bump up. PSU banks have done well, as have select spaces such as sugar and specialty chemicals. So for an investor looking with a 3 to 5 year time horizon to possibly maximize his returns, where could those pockets in the markets be which possibly haven't been discovered yet or aren't being talked about in so much detail right now?
See, I think two space which are well known. One is the public sector banking space. Still the valuations are quite low, and most of the NPAs which has been done due to AQR is more of a book entry kind of a provisioning thing which has been there. So the type of growth which we are looking forward to economy, around 18% kind of a CAGR growth we are expecting for the earnings of listed companies to grow in next 2 years time frame, and GDP should grow at around 7.6 to 8% of growth. So if that has to materialize, so things should start improving at the ground level, and once you start reversing the provisioning, the profitability will grow exponentially for all the public sector banking space. So that is one pocket which one should, as an investor, one should be looking at. So margin of safety is high, valuations are quite low, and we are betting on an economy which has to recover. It's not a stable economy we are talking about. We are aggressive on the economic growth of the country as such. And the second space which I think well-known space is the metal space. So if the world economy stabilizes and there's some growth traction coming, because we already have 4 or 5 years of our degrowth in the world economy. It's been consistently the world GDP has been going down. So if that reaches an inflection point in next 6 months or 1 year time, we see a reversal out there. So that is one space which will fly real hard. In India, we have already seen firming up of metal prices. Domestic demand has been good. If that translates to the world, so that space will also pick up a good traction. And the last one would be again the consumption space, white goods. Any company related to white goods, be it small electrical appliances or kitchen appliances, AC, fans, electrical bulbs, these are the space so one should be looking forward to. In a scenario where the interest rates are coming down and otherwise the overall rural consumption is picking up on back of good monsoons and 7th pay commission, GST rollout will be another big trigger. So all this will make, I think, all the economy vibrant, and the direct beneficiaries would be the public sector banks, metal and white goods space.
Metals, Dharmesh, in the background that you just highlighted, are we possibly looking at some kind of a revival coming in the metal space? The government has also extended MIP by another 2 months, but it really could be possibly a demand revival that could happen going forward, and that could provide a leg up to some of these names?
Yeah, definitely it has to be a demand revival. Otherwise, supply constraint cannot pull the prices up, because already all the producers were sitting with excess capacity, and they don't have demand coming in the global economy. So what essentially has to be seen is how the global demand for metals recover. So that will be the prime trigger. As far as domestic demand is concerned, the MIPs are a protection mechanism. They are not going to drive the demand up. In fact, they are to protect the domestic companies. So I don't think that should be the reason for a value investing for 3 to 5 years. At best, that can be a good trading place. But for value investing, it has to be actual demand pickup on the global front, and that is what I am expecting should materialize by FY18.
Right, Dharmesh, thanks a lot for having joined us right here on Lunch Money and for having taken us through your views. And of course, thanks for that. But however, we're taking a short break right now. The conversation on the markets continues on the other side.